Welcome to the debate. Today, our discussion centers on the future trajectory of PayPal Holdings, Inc., stock symbol PYPL. We're tackling a pretty crucial, forward-looking question. Is PayPal's current, very diversified strategy truly effective in mitigating some significant structural headwinds and positioning the company for, well, accelerated long-term growth? Or are these multifaceted initiatives primarily defensive, designed more to achieve, say, balanced but ultimately slower growth when you compare it to its more specialized competitors in the payment space?
Exactly. And our conversation today, it emerges directly from a comprehensive research report by Compasscope, alongside, the insights we gleaned from PayPal's own Q2 2025 earnings call transcript.
Right. And I'll be arguing that PayPal's multi-front strategy, its sheer scale, and frankly, its recent execution momentum clearly demonstrate its capacity not just for growth, but for accelerated growth and maybe even a renewed position of market leadership.
And I'll be taking the counter view. While PayPal's strategy certainly promises, solid revenue and profit potential, a deeper look, I think, reveals it's largely a defensive play. It's really a strategic response to significant structural pressures in the market. And this, in my view, points to a future of balanced growth, sure, but not necessarily accelerated growth, especially when we consider their specialized peers, whose competitive advantages, though still substantial, are becoming, as that Compasscope report puts it, less unassailable.
Well, let's start with the results then. PayPal's Q2 FY25 results. In my opinion, they provide a really compelling argument that the company is indeed heading towards acceleration. Management themselves explicitly noted, and I quote, "Growth will accelerate in line with our three-year outlook," and this followed what was objectively a very strong quarter. Let's look at the numbers for a second. We saw transaction margin dollars grow by a healthy 8%, even excluding the interest earned on customer balances. And non-GAAP earnings per share, which gives us a clearer picture of operational profitability by excluding one-time items, increased a robust 18% year over year. These aren't just figures reflecting maintenance. They are clear indicators of profitable growth building significant momentum.
Okay. Strong numbers on the profit side. I'll grant you that.
Right, but beyond the headline numbers, PayPal's key strategic initiatives are also thriving. Venmo, for instance, saw its revenue surge over 20% year over year. And total TPV, that's total payment volume, the aggregate value of all transactions processed, that increased by a solid 12%. Branded checkout penetration, where customers actively choose PayPal at checkout, improved by a mid-teens percentage point, largely due to new AI-enhanced payment flows that really simplify the user experience. And looking ahead, the recent announcement of PayPal World is, for me, genuinely a game changer. This is an ambitious initiative designed to unify 5 of the largest digital wallets globally: PayPal itself, Venmo, Mercado Pago, TenPay Global, and UPI. Now, what this means in practical terms is just a massive expansion of PayPal's reach to over 2 billion consumers worldwide. For merchants, it drives an expansion of TAM at the existing economics, TAM being total addressable market. So this means their current PayPal integration will automatically be able to accept payments from customers using these new wallets, widening their customer base without needing new technical development or incurring higher fees. This kind of fast and focused execution is clearly strengthening PayPal's value proposition, attracting top brands and developers, and it gives me strong confidence in future acceleration.
I hear your enthusiasm. I really do, especially for the Q2 results in those strategic moves. But I'm looking at it from a fundamentally different angle. While I fully acknowledge PayPal's immense scale and brand trust and its, yes, undeniable, broadest multi-rail competitive advantage, that Compasscope research report offers a rather sobering conclusion. PayPal's advantages, while still significant, are becoming less unassailable. The core issue, as I interpret the data, lies in the intense structural pressures that are, I think, uniquely challenging for PayPal. These include significant wallet substitution, consumers just opting for alternative digital wallets, regulatory margin pressure, the rapid rise of real-time payment rails, and volatility within BNPL credit cycles. Together, these pose greater incremental threats to PayPal than to several specialized peers.
Okay, but are those threats materializing significantly yet?
Well, I think we're already seeing tangible evidence of this share erosion. For example, Apple Pay's online share reached a notable 14% in 2025, and crucially, it's growing faster than PayPal's traditional branded button. Regulatory headwinds are another major concern. I mean, consider the proposed U.S. debit card interchange fee cut of approximately 30%. This interchange fee is what merchants pay to process debit card transactions, and a cut this deep could significantly compress take rate economics for PayPal. That's the percentage of a transaction PayPal actually keeps as revenue. That's a direct hit. Furthermore, the adoption of real-time bank transfers like FedNow, this new payment infrastructure, enables direct account-to-account or A2A payments. Now, this is a significant threat because it allows funds to move instantly from a consumer's bank account directly to a merchant's, potentially bypassing wallet intermediaries altogether, essentially cutting out the need for a service like PayPal as a middleman in many cases. Look, even management has flagged concerns about slower core growth and a muted forward revenue outlook. Analysts are pointing to branded volume softness despite those profit guidance raises you mentioned. All this suggests to me that the current strategies, while maybe improving profitability, are more about maintaining their position rather than truly accelerating past these significant market shifts.
You've highlighted some concerning trends, absolutely, and I agree the landscape is competitive. It's fierce. However, when we talk specifically about branded checkout, PayPal's deliberate focus on winning checkout through these upgraded user experiences is, I'd argue, unequivocally yielding strong results. It's not just about defending market share, it's about actively improving the fundamental user experience to drive more transactions. We're seeing mid-teens percentage points of global transactions now occurring on their latest platform, and maybe even more impressively, over 60% of US checkout transactions. These aren't minor tweaks. These upgrades are demonstrably driving meaningful conversion rate improvements, meaning simply, more shoppers complete their purchases when using the new PayPal experience.
Okay. Conversion improvements are good, but what about overall volume?
Well, consider the new Payment Ready API. This isn't just a technical update, it's a smarter system that identifies customer preferences up front, personalizing the entire payment experience. This proactive approach significantly increases conversion rates, moving beyond just simple button placement negotiations to genuinely enhancing the shopper's journey. This feels like proactive innovation designed for growth, not just a defensive reaction. And my earlier point about PayPal World remains incredibly relevant here. It further extends PayPal's branded checkout reach to billions of new customers globally, ensuring merchants access a wider total addressable market, importantly, with their existing economics. This isn't just about holding the line, it's about expanding it, potentially dramatically.
Well, I appreciate the emphasis on these internal improvements and, yes, the potential of new initiatives like PayPal World. The real-world impact on overall online branded checkout volume, well, it tells a bit of a different story. Despite these, as you say, upgraded experiences, online branded checkout TPV, total payment volume, grew only 5% on a currency-neutral basis in Q2. And according to the earnings call itself, that 5% is simply consistent with what we've been seeing over the past year. Now, to me, that indicates a distinct lack of true acceleration.
But consistency can build momentum.
Perhaps, but it suggests that while these cutting-edge features are providing an uplift, they are primarily just offsetting headwinds from platforms and merchants in Asia due to tariffs, which actually cause volumes to decelerate in those regions. So if your advanced features are mainly fighting just to stand still against external drag, that's not acceleration in my book. That's a formidable holding action at best. Furthermore, we just can't ignore Apple Pay's online share surging to 14%. That's not just a competitor, it's a direct, substantial competitive threat that's clearly taking share. And more critically, the rising adoption of real-time bank transfers like FedNow introduces what I would call an almost existential challenge. This allows direct account-to-account payments to bypass wallet intermediaries entirely. Think of it like money moving through a high-speed train, instantly from one bank account to another, potentially cutting out the station that a digital wallet like PayPal often represents. This isn't just about improving a button. It's about the very relevance of the wallet's role in the transaction flow going forward.
Okay, I understand your concern about the TPV growth figures and those external competitive pressures. Definitely. But let's consider the broader strategic pillars for a moment, which are designed to drive both volume and margin expansion. It's a comprehensive approach to profitable growth. Venmo's repositioning, for example, is, I think, unequivocally successful. Its revenue is up over 20%, and Pay with Venmo TPV is up over 45% in Q2, significantly boosted by those strategic college distribution deals that are bringing in a whole new generation of users.
The Venmo numbers are strong, yes.
Exactly. Then look at their omni-channel solutions like the PayPal and Venmo debit cards. TPV for these grew over 60%, and MAUs, monthly active users, jumped over 65%, adding an impressive 2 million new users in Q2 alone. These aren't niche initiatives. They're expanding PayPal's presence in everyday spending, online and offline. And the Germany launch of a contactless NFC wallet achieved 3 million enrollments and an incredible 16x increase in monthly transactions. This demonstrates, I think, immense global potential for in-store payments.
A good pilot, certainly.
And even the PSP business, the payment service provider side, has apparently hit a positive inflection point for Braintree volume. After a strategic reset, they're now expecting acceleration in the second half of the year, and they're boosting profitability there with value-added services like Hyperwallet. Furthermore, these new next-gen vectors, like advertising, both off-site and storefront ads, and the PYUSD stablecoin, which is their own dollar-pegged digital currency aimed at reducing cross-border transaction friction and costs, these offer entirely new avenues for high-margin growth. This looks like a multi-pronged strategy that's about aggressive expansion into new, lucrative areas, not some kind of defensive retreat.
You've certainly painted a picture of broad diversification, no doubt about it. But let's consider the significant external headwinds this very strategy of focusing on profitability and these new ventures faces. That proposed 30% cut to debit card interchange fees, for instance, it isn't just a minor blip. It could directly compress take rate economics across a really substantial portion of PayPal's business. That's potentially a significant hit to their core revenue per transaction.
A potential hit, yes, but regulations often get negotiated down.
True, but the risk is there. And in the buy now, pay later segment, while it's growing, it's also increasingly exposed to credit risk and funding cost, largely due to a broader industry late payment uptick and higher interest rates. This inherently raises PayPal's loss exposure. We already saw transaction losses tick up by 9 basis points in Q2, with a full-year run rate expected at 8 BPS. Now, they attributed this partly to new product introductions and what they call normalization, but it still suggests their growth in certain areas isn't coming without increased risk.
Risk is inherent in lending, though.
Of course. What's also important to consider, though, is that while PayPal diversifies across many fronts, its peers pursue more focused bets. Think of Block, for example, really concentrating on its consumer financial super app, or Stripe, which is just laser-focused on developer infrastructure. These focus strategies, while maybe they have narrower profit pools or heavier execution dependencies, often deliver higher top-line growth rates. This suggests that PayPal's current very broad strategy is not necessarily the highest growth rate compared to these more specialized competitors. It might achieve balance, yes, but perhaps at the cost of that genuine acceleration we're debating here.
I'm not convinced that these external headwinds fundamentally undermine PayPal's ability to accelerate, though. My reasoning is that the execution momentum itself is, well, undeniable, and it's allowing PayPal to navigate these challenges pretty effectively so far. Management reports tangible momentum across the business and an accelerated pace of innovation. And they're achieving this, it seems, by consolidating platforms and aggressively leveraging AI to improve efficiency and the customer experience. The rollout of new branded experiences, the transformative shift we're seeing in Venmo's commerce capabilities, and the initial traction for PayPal World, all of these initiatives indicate strong, consistent execution, in my view.
Consistency, maybe, but is it translating fast enough?
Well, we have specific examples. From the uplift in conversion rates, from the upgraded checkout experiences we discussed, to the remarkable success of that Germany NFC launch, which demonstrated their ability to rapidly scale new products in critical markets. Furthermore, the company's ability to navigate a challenging reset within their PSP business and now project Braintree volume acceleration in the second half, that shows effective management and strategic control in overcoming obstacles. These aren't just theoretical plans on paper. They are successful initiatives gaining demonstrable traction, clearly showing, I think, management's capability to deliver on their promises of accelerated growth despite a challenging external environment.
Look, I can see the argument for internal momentum. I can. But the critical question remains whether that momentum translates into actual market share gains and accelerated core growth. Management itself flagged concerns about slower core growth and presented a muted forward revenue outlook. That understandably raises concern that product refreshes are not yet restoring share against their aggressive competitors. The numbers on overall branded checkout volume seem to reflect this hesitation.
Okay, the outlook was cautious, I'll give you that.
Right, and moreover, there have been operational stumbles. That July 2025 fraudstring disruption in Germany, which led several banks to temporarily block PayPal transactions, well, that highlights inherent platform stability and risk model challenges. That kind of operational incident can significantly undermine user trust and adoption, especially in crucial European markets. And let's not forget the company is undergoing a pretty large-scale restructuring, a $300 million multi-year program that involves workforce reductions and data center exits. Now, while these are often necessary for long-term efficiency, such a massive undertaking inevitably introduces execution, complexity, and transition risk that must be very, very carefully managed. These internal challenges, compounded by an already fiercely competitive landscape and the external pressures we've discussed, make achieving true, sustained, accelerated growth a much more precarious endeavor, in my opinion.
Okay, so as we bring our discussion towards a close, my position really remains clear. PayPal's Q2 results offer compelling evidence of a company successfully executing a complex, multi-front strategy. This approach is driving substantial, profitable growth across key segments like Venmo, omnichannel solutions, and branded checkout, significantly enhanced by new AI-powered flows. Groundbreaking initiatives such as PayPal World and the PYUSD stablecoin, they aren't just defensive plays in my view. They demonstrate a forward-looking vision and a deep commitment to innovation. PayPal is leveraging its unmatched scale and brand trust not just to survive, but to expand its reach and value proposition in new and exciting ways. For me, the evidence strongly supports management's confidence in achieving accelerated growth and actively shaping the future of commerce.
And my perspective remains that while PayPal is undeniably active and, yes, investing heavily on many fronts, the data we've explored suggests that these initiatives are often more reactive or perhaps defensive in nature. They really feel like strategic moves against significant and growing structural challenges. Everything from regulatory pressures on interchange fees and BNPL to aggressive wallet substitution by rivals like Apple Pay and the emergence of those real-time account-to-account payment rails. PayPal's advantages remain material, yet are becoming less unassailable, as the research states. This implies to me a trajectory of what I would call balanced and achievable growth, rather than a genuine acceleration that would allow them to regain the kind of dominant, unassailable market leadership they once held.
Right. So our discussion today really underscores the intricate challenges and, yes, the vast opportunities facing a giant like PayPal in this rapidly evolving payments landscape. We've seen how internal innovation and strategic diversification are kind of pitted against formidable external pressures and shifting market dynamics.
Absolutely. Listeners are really left to weigh whether PayPal's impressive scale and diversified efforts will indeed lead to a renewed period of accelerated growth, or if these are perhaps strategic defensive moves primarily aimed at maintaining a strong but maybe less dominant position amidst fierce competition and ongoing regulatory shifts. The complexities in the source material certainly offer ample room for further thought and analysis beyond our conversation today.
This content is produced by Compasscope.com. For more than 1,100 public listed companies, find detailed research reports, visual mind maps, earnings call analysis, and audio discussions on Compasscope.com.